Thank you all very much for being here today. We have a very important topic to discuss, which is the role of development finance institutions in mobilizing private capital to finance the sustainable development goals in emerging market countries. I'm Alison Harwood. I'm a senior fellow in residence with the Milken Institute's Global Markets Development Group. We have an excellent panel to discuss this issue with, each with a very different but very relevant perspective. Who is the CEO of Convergence, which is the largest global network on blended finance. Amit Bori, who is the CEO of the Global Impact Investing Network, which represents the investing community around the world. Nancy Lee, who is a senior fellow at the Center for Global Development, who's focusing much of her work on this very topic. And Monish Mohakar, who is the Vice President of Corporate Strategy and Resources at the World Bank Group's International Finance Corporation, where he is spending a lot of his time also on this issue. So I think we can now bring them all up. There they are. Welcome. So the Sustainable Development Goals have created a very ambitious development agenda and an ambitious financing agenda to go along with it. There's an estimated $2.5 trillion in an annual financing gap, which private capital is expected to help fill. And this means raising unprecedented amounts of private capital to help finance development. The good news is that there's a growing group of institutional investors around the world who are really keen to invest to create a more sustainable future. And they're using the SDGs as a frame for setting their investment strategies. The challenge is that a lot of the financing is needed in areas that are new for these investors, new technologies, new countries, new sectors, raising a lot of concerns for the investors about the risks of these investments and the returns. Added to that is that many of the countries that need this financing have underdeveloped project pipelines and underdeveloped financial markets to invest in. So DFIs are being looked at to help be a bridge, to de-risk some of the investments, to provide concessionary financing, and to help build pipelines and markets to catalyze some of the billions to trillions of private investment for the sustainable development goals that everybody is talking about. To date, this is not happening to anywhere near the levels and the speed that was intended. The rate at which DFIs are catalyzing private financing is very low. The private capital mobilized for the SDGs in emerging market countries is very low, more in the low billions and anywhere near the trillions. And this is slowing what is really a very, very important and in many cases urgent development agenda. So today we want to discuss three questions around this issue of DFIs and increasing their ability to mobilize private capital for the SDGs. First, what were the DFIs expected to do and what key things are not happening? Second, why are these not happening? And third, what are some ways or solutions to help DFIs strengthen their ability to mobilize private capital? So with that, I'm going to start with Joan, and we're going to look first at what was expected and what's not happening. And you're very closely involved with this, being in the middle of all the issues around blended finance. So what was expected and what are we not really seeing?
Thanks, Alison. I guess I would say that I would have expected the development banks, development finance institutions to do three things. One is to do landmark transactions. So there's a development effect of telling other people the art of what is possible, laying out what the real risks are versus the perceived risks, and setting long-term debt pricing in markets where that kind of instrument's not there. I think that's been done. There's lots of landmark transactions done by the DFIs. The second thing would have been to mobilize other people's money into transactions in these same developing countries and growing economies. By allowing other investors into the same transaction, offering the halo effect, doing syndications. I would say that's been sort of done. That is, there's no doubt that billions of dollars have been catalyzed by development banks. But if you look more closely, they didn't engineer their entire process for that effect as much as they could. And I would say that mobilization has happened more in established places where syndications and bank syndications are possible, and not in low-income countries. And certainly they have not used their guarantee instruments as much as could have been envisioned, which would have unleashed a lot more local currency financing. And they have done some really interesting balance sheet transactions but again, not enough of them. And the third thing, besides mobilizing, is to go into the least developed countries, the low-income countries. And that's certainly not done. Our statistics on blended finance show that, and I'm happy to go into detail, but let me pause there.
Okay, good. No, and a large amount of the financing is really needed in the lower income countries, right? And so the fact that that's been very slow to move is a real issue here.
Yeah, just very briefly, our statistics cover only blended finance deals. These are transactions where not only is a development bank offering a market priced loan, but somebody is doing something concessional. That's the trigger for the definition of blended finance, that some concessional money, catalytic money is in the deal. What we've seen is across the board, the 600 or so transactions that we have cataloged, about a quarter of them are in low income countries. Now, across the board, something like 79% of them, 79% of all blended transactions we know about have had DFIs in them. But the DFIs themselves also are only in the low income countries 28% of the time. In other words, their patterns are very much like everybody else's patterns in blended finance. They're very heavy in blended finance, but they're not disproportionately showing up in the low income countries. They're kind of looking like everybody else is in the low income countries. So perhaps, you would have expected a skew that I'm not seeing there that would have demonstrated heavier interest in the low income countries, where you would imagine blending would be more important because it's really hard to create investable transactions sometimes in the low income countries.
Right. Okay, so Nancy, same question for you. What are your thoughts on what's expected and what you're not seeing?
And I think what I'm about to say is really going to complement very much what Joan said. The way I think about this is to start with the question of what are the pervasive gaps in capital markets in low income and middle income countries that really block the flow of finance, and then work backwards to think about the kind of development finance institution that really can address those gaps. So let me suggest my list of 4 gaps is what I've seen over and over again. Others may have a different list. So first of all, early stage finance for firms and for infrastructure. Second, local currency finance. Third, finance for innovations in systemically important sectors. And then finally, finance for excluded population, like women entrepreneurs that also need innovative approaches. So if you think about the gaps in that way, then you think about what kind of institution can address those gaps. It has to be an institution that can manage a lot of risk and uncertainty. It has to finance young firms and greenfield projects. It has to build market infrastructure for new products, new technologies, new business models. And it has to benefit multiple firms and multiple market entrants, because the idea is to create healthy markets, not monopolies. So you need an organization that's very focused on scaling innovations and building markets, not just individual transactions. You need a staff skilled in a range of financial products of the kind that Joan just described. And you need a way to manage the DFI balance sheet effects of investing in early stage companies when market valuation is hard. It takes a while for investments to mature, and some are very likely to fail. So what's happening is that DFIs are being asked to graft these kinds of capabilities on what is essentially a commercial bank model. And so it would be no surprise to any of us that they're struggling with this, and some of them are doing it better than others, but it is a very substantial transformation of their model.
Yeah, no, and you raised this important point. I mean, when you call them a commercial institution, because I think for a lot of people that would surprise people to call them that, because they're typically talked about as a development institution, which is supposed to catalyze development and commercial money coming in. So I think we're going to come back to that to that point. So Ahmed, I wanted to also talk a little bit about the technical assistance side, because obviously, if you don't have project pipelines and you don't have markets that work, you could de-risk and provide concessionary finance forever, and it wouldn't do anything because there'd be nothing to invest in. So what are you seeing from the technical assistance side? I mean, and you're representing investors who people are looking at to put their money into these purposes.
Well, thank you. And just to build on what Nancy said, I think it's really important about this tension between being a commercial entity and operating kind of on the same terms that you'd expect a commercial investor to operate with, versus actually going where the markets don't go. A true developmental agenda that extends the reach of the capital markets through many of the different dimensions that you mentioned in terms of priorities. So our network includes development finance institutions, but the majority of our network are private investors, huge global institutions or specialized firms that are looking to have a positive impact alongside their financial return. And in emerging markets, the development finance institutions have really paved the way for a lot of the private impact investors to enter the market. But what I think is important to emphasize is that development role that's so playing the work to actually build up new business models, seed the innovative approaches, really trying to build the pipelines and the enabling environment that allows other investors to operate. And I think Nancy's points really resonate well with me, because I think what we're seeing now is the frontier of where development finance institutions are needed is evolving. When many of them were founded, there were very little, there's very little investment activity in many of the markets they're focused in. The private, investment community is actually putting more capital work in many of those middle-income countries. So then the question is, how do they extend the markets? How do they help, seed, and make them more investable in areas and communities that haven't received as much capital, or in countries that are generally underinvested in? I think that's a critical question for the future role of DFIs, is how to navigate that tension.
Okay, no, thank you. So, Monish, you're here representing the DFI view, and you're in the middle of IFC working a lot on these issues. How do you respond to all of these comments?
No, thank you, Alison, and I think my fellow panelists outlined some of the challenges really well, and we have ourselves at IFC been grappling with many of these over the past few years. And what I can share is that certainly in recent years, there has been a strategic shift and a transformation going on at IFC to address precisely some of these challenges. So just to give you a few numbers here, I think over about, say, 10 years, from 2010 to 2020, IFC cumulatively has done about $1.6 billion of concessional finance deployed into our projects, which are then, of course, leveraged through our own capital and mobilized capital. But more than a third of that have actually happened just in the last couple of years. And that ramp up was mainly due to the introduction of the private sector window. And this is a unique instrument that actually deploys a portion of IDA capital, which is basically the World Bank's soft loan window, which traditionally lent money only to governments. But we were successful in carving out a portion of that balance sheet in order to work alongside IFC's own capital and risk-taking appetite. And why this is important is because, to the point that I think both John and Nancy were making, in order to address the challenge of these low-income countries, where it's incredibly hard to find the right risk return for private investors, you have to go in and specifically de-risk certain types of almost non-commercial risks, which make projects unviable for private sector investors. So this is the capital that we have started now bringing in, very specifically focused only on low-income countries, which are what we call IDA and countries. The second point I would make before turning it back to you, Alison, is that while the challenge of bringing capital, private sector capital, beyond the DFIs and beyond concessional finance is hugely important, to the point that you made, that the scale of the challenge is huge.
Yeah.
And while we do believe that there is a lot of capital out there, institutional capital, looking for investment opportunities, a big part of the challenge that we've identified in these markets is that notwithstanding blending or notwithstanding investor interest, these markets simply don't have the right enabling environments. They don't necessarily have the right regulatory conditions to allow these projects to become viable. And that's the other big strategic thrust that we have placed our resources into in the recent past, which is building a set of capabilities we call upstream, which is, as literally the word implies, going much further up in the project or investment cycle to a point where those projects may not be visible or may not, let alone being viable, but we will go in there with certain dedicated specific capabilities, which we have now built recently in IFC, but then also partner with our World Bank colleagues or with other development partners to start actually the hard work, which takes many years, of building those enabling conditions, building that enabling environment, working with governments and regulators, so that we can start identifying meaningful projects over a 3, 4, 5-year time frame. Because without that hard work, all of this capital which is out there waiting to be put to work, even with the blending and de-risking, simply won't be able to find those matching projects. So I did want to identify that as an important point for our consideration. Thank you.
Yeah, no, that's all extremely important, and we're going to want to come back. We're going to want to come back to that, because I do think that sets a lot of the discussion around solutions and the way forward. So we will want to come back to all of those comments. And I think one question before we do go on to talk a little bit about why this is the situation that we have right now is also, there's a lot of different kinds of DFIs out there. Are you seeing some DFIs that you think are doing more of what's needed than others? And if so, what is it about them that maybe others can learn from?
So I think, Alison, maybe I can take a quick crack at that, and let's hear other colleagues as well. We have certainly been working with other DFIs in partnership to agree on certain blended finance principles. And why that's important, there are probably other DFIs who have experimented with an applied concessional finance, maybe on a larger scale. But what we need to be very careful about is that concessional finance can also have market distortionary effects, because ultimately our collective goal here is to create the kind of markets that allow private sector to function. So it's to that extent that we have been working with them to ensure that some basic principles, like just to name one,
right,
concessionarity to get over the threshold of bankability. That's an important point that we've been talking to everybody else about as well.
Right. Yeah. And again, I want to come back to all of these points, because I think they're all at the center of this issue of what's happening going forward. Anybody else before we just move on? Any other comments about other DFIs?
Yeah, I can jump in, Alison, and just make three very quick points. The first is, I think it's helpful in this context to just distinguish between risk sharing and risk reduction. And on the risk sharing front, I think they're mostly DFIs have done senior lending traditionally. It's something like 80% of their portfolios, but there's some DFIs that are doing a lot more of the more catalytic instruments that we've been talking about, essentially guarantees and subordinated positions. So there is some variation, which demonstrates that it is possible to run a financially sustainable DFI that does a lot of equity, for example. Number two, Manish is really talking about reducing risk when he talks about the enabling environment and this upstream effort. And it seems to me that one sort of guiding principle for DFIs is when they deploy subsidies in the form of grants, they should really be seeking to benefit multiple market actors, multiple firms, not individual firms. So I would say it's important to sort of get away from this notion of, the idea for technical assistance is to advise individual firms. I think it should really be more focused on market building, market infrastructure building, information gap closing, that kind of things that benefits multiple firms. And then the last thing is just to say very briefly, I'm not sure people understand how small blended finance is in volume in DFI operations. The major DFIs, both multilateral and bilateral, together deployed about 3.5 billion of blended finance transactions in 2018. So that's globally for all developing countries, which was only about 6% of their transactions. So as someone was saying, their transactions are mostly commercial transactions. And the entire volume of the subsidy part of blended finance for 2018 was about $1 billion for all of these DFIs. Yeah. So the point I was going to make is it's a question of how you allocate the concessional finance, but it's just not big enough. You're not going to change the world or move from billions to trillions if you're talking about $1 billion of concessional finance a year.
So you're getting into the point about why, and I want to pick up on that. Monish, I know you want to comment on this point about enabling environment. Or I can, because I know you're doing a lot of work. There is work that's being done with individual companies, but I think the point, if I understood you correctly, that you're trying to emphasize is the more broader enabling environment, building markets that everybody can use.
Yes, indeed, and I completely agree with what Nancy just said. That whereas for us, and I think for many other DFIs, the traditional type of advisory services, technical assistance work was indeed focused on firm level capacity building, and that's important to continue. But I think the big new thrust is exactly to her point that this is about market building. That upstream work, while it needs to be very focused in terms of identifying investments and viable projects, but then those projects are not necessarily only for IFC loan financing. Many of those are going to lead to market development that could be financed by any number of other private sector players as well. And in fact, to some extent, that's the risk and cost that we are willing to incur because this is, of course, an expensive activity needing skills and needing a lot of staff and project expenses. But we are willing to do that precisely to be able to open the markets, because if we as DFIs don't do that, then we will be stuck in this kind of low, availability of projects kind of situation where everybody is chasing projects. And even if you bring blended finance into it, it simply becomes a pricing game or a competitive game and a race to the bottom. That's exactly what we are trying to overcome.
Avoid. Right. Yeah, right. So, and that, as we all know, is very long time ago. No, Joan, so I was going to turn to you now.
Yeah.
Go ahead.
Just a couple of thoughts here on the scale of all this activity. The scale of the Sustainable Development Goals, the financing gap is in the trillions per year.
Yeah.
None of us are operating on that level. And if you were talking about bridging via blending, what makes a blended finance transaction blended, again, is the element of there being some catalytic capital that's not operating on pure market principles, but is there to buy impact or to get something going that otherwise would not spark. So that money is the variable that determines the scale of the market. That money plus the mobilization factor, the leverage factor it gets, the number of dollars per dollar of that can be drawn in. That's the limiting factor here. Official donor aid is flatlining. It's at whatever year, 150 billion a year. I said billion, not trillion, you notice. They're in the wrong order of magnitude. So that money is not going to increase anytime soon. So whether it is a check of that sort of money written to an institution like IFC to blend, or whether it goes into other kinds of transactions, it has to be operating at maximum impact. Maximum, by that I mean financial impact, leverage. We need to get the most dollars per dollar out of that equation. Where the development banks have been good is in putting transactions together that use solid principles in blending. Where other folks are doing more and interesting work is, for example, foundations will show up as the only party in a transaction and get the transaction up and running and bankable and proven out to the point where a development bank or a DFI or a commercial investor can step in. DFIs don't tend to take that role very often. They don't go in the early stages. They're not as comfortable there as other more private sector philanthropic actors are. So there is one place where I would say other parties have done more work. There's just a whole lot of work there to be done, and it's hugely catalytic. I mean, we work in part in market acceleration by putting dollars into feasibility study stage and proof of concept study stage financial transactions, and the leverage is enormous there. We've spent probably $6-7 million so far and have seen about $500 million come in behind it as these transactions go to market. So you can get enormous amounts of leverage. I caution about the leverage because the objective should never be let's get 15 times leverage in this transaction, because then you all start chasing leverage and then you start putting blended finance into the easier deals just to get the number. But it is another thought for you, in addition to early stage of projects, is early stage of countries. Perhaps if more blended resources were pushed down into the lower income countries, and DFIs were taking more risks in the lower middle income countries without blending, perhaps that very, very scarce capital would be used to better advantage. So we're talking about bridging via blending. My point is there's a bridge in the early stages of projects, and there's a bridge in the early stages of markets that could be really served by really careful allocation of that catalytic capital. And we all have to really keep focusing on that. And I know everybody on this conversation does focus on that, but we have to.
Right. I don't know, Amit, if you, and I do want to go back to this question of why, though, because I think the why becomes important to what the solutions might be. But Amit, do you want to comment on what's been said so far?
Yeah, I think this is, this question about how to engage with DFIs is really important when we think about the mobilization agenda. And one thing I can speak to is that interface between DFIs and other private investors who are focused on achieving a development impact. And that's largely what we have in our network. One of the areas where I think there's a challenge, of course, is the diversity amongst the DFIs themselves. So we heard from Manish kind of how the IFC approaches this and structures it. But when we're thinking about different ways of partnering, whether it's a commercial capital or more catalytic or kind of blended capital and other instruments, for a private actor, getting to know one DFI helps you kind of get to know one DFI, if you will. And so I think figuring out how to partner with the multitude of great institutions that are focused on development finance is one challenge. And then, and I think it's really important for most private investors don't have a lot of experience working with these kind of publicly backed institutions. I think the diversity is understandable. They all have different shareholders, and different stakeholders that they're responding to. And certainly the bilateral ones have, different kind of like local political context in which they operate. But it is a challenge when we think about how to mobilize greater capital at scale, efficiently and fast. One area that I do want to highlight, though, where this enabling environment and this bridging between the private investment capital and the DFI capital has worked quite well, is an effort that the IFC and the European Development Finance Institution Association, or EDFI, has worked on with us, which is around the harmonization of metrics. How do we actually understand the social and environmental impact we're having? The DFIs have been working to harmonize amongst themselves for several years. And more recently, we've been partnering with them as the GIN through our IRIS Plus system to work to harmonize metrics as a way that we can get the private impact investment community and the development finance community speaking the same language or working from the same playbook. And I think that is, one way in which we can start to see, hopefully one big example of getting all these different institutions on the same page that will help with the broader mobilization agenda that is so critical to meeting the SDGs.
Yeah, no, and this is a really important point that people should not forget about is the whole impact measurement, because as we get more and more investors identifying themselves as impact investors, and we all know that, we're hearing this more from BlackRock and Morgan Stanley and all these places, that they're increasingly saying, hey, I need to be able to measure and verify that I've had impact. So getting those impact points in place is really important. And as you say, we're seeing more DFIs working on that, particularly what IFC has recently come out with. But let me go back to another question that I think several of you have mentioned in the past when we talk about where DFIs are and their ability to change, is the question of sort of how they operate internally, right? And how they see what their goals are, what incentives they give. There are shifts that have to be made. I mean, DFIs have always been talking about being very volume focused, and how do you see all of that influencing the ability to play the role that DFIs are being asked to play today? Who would like to start with that?
I could start
Okay.
as a former shareholder of the institutions. So these institutions are owned by governments for the most part, certainly multilateral institutions. So the first thing is that the governors of the institutions, the executive directors of the institutions, first and foremost, view it as their fiduciary responsibility to ensure that these are financially sustainable institutions. So, and now I'm talking about the private finance arms of multilateral banks, not the. So they care about ratings, institutional ratings, and they are very concerned about a reduction of the ratings, partly because of their fiduciary responsibility, but also because they don't want these institutions to have a higher cost of capital. So that's the first thing. The second thing is they, of course, want these institutions to grow over time, certainly in the current period where we've got the SDG finance gaps, now layered over by this enormous need for counter finance for the DFIs to respond to the pandemic. So they want these institutions to be able to increase their lending capacity. They don't, however, want the institutions to go to shareholders, governments, frequently to ask for more capital. They prefer for these institutions to be able to expand their capital using their retained earnings. And that is when you look at, an institution like IFC over time, it's grown mostly because of retained earnings, more than the periodic increase for holders. So there is a desire for profitability for these institutions, which constrains what the institutions can do in terms of taking risk. At the same time, and I can say this as being in the shareholder seat, there's lots of a desire to see that the public money that go into these institutions are used for clearly developmental purposes, including for increasing activities in low-income countries. And that was a condition of the recent IFC capital increase, a very substantial increase in their activities in low-income countries. Mm-hmm. So all this is by way of saying, in answer to your question, shareholders are a little bit conflicted in their approach. They are giving mixed messages to these institutions, and I think that to some degree results in that causes the outcomes we're seeing in terms of their risk, the limited amount of risk they can take.
Right. In a context which has really changed pretty significantly, right? With big amounts of money being talked about, a lot more of it in lower income countries, and trying to get it there with speed. I don't know, Joan, do you want to comment on that as well?
I comment not as a shareholder like Nancy, but as a previous investment officer in IFC for a decade. The hard things are hard to do. So you find that if there's a way to do a transaction with only IFC as the sole outside financier, that's an easier transaction to do than a transaction that's engineered to get other people's money into it. So fundamentally, mobilization is an extra thing to do when you're trying to get your project across the finish line. It involves more parties, it involves more terms. And so if there's a way to do it on your own and there's volume pressure, you're going to do that transaction with just IFC money as the outside source of funding for the deal sponsor. There are transactions that investment officers in these institutions will work on for years. They are passionate about making something work, and they will spend their lifeblood getting it done. It takes 5 years, and someone in management will say, keep going. So there are these spots where they will really stretch and really do something tough. But there's not an institutional bias toward doing those transactions, those truly difficult transactions that will unleash a new flow. So where it happens, it's the exception as opposed to the rule. And when your shareholders are saying, we expect you to grow 3% this year or deliver this bottom line, you are going to take the simpler deal. And that's one of the reasons, for example, why I think guarantees are not used more often. Because if IFC lends money, there's a loan agreement. If IFC guarantees something, then it has to guarantee something in which there's still a loan agreement that somebody has to negotiate. Yep. And now you have to negotiate how the guarantee fits on top of the loan agreement. Now you have 2 sets of fees, and now you have complexity. So institutionally, there would need to be some signal from shareholders that the growth imperative is moderated by this imperative elsewhere. That is, you want to see X% of your stuff happening in low-income countries, or Y% happening where your money is, not the only money in the deal, or something. There has to be a clear signal, because investment officers in these places work really long hours. They work really hard, and to add without any institutional signaling, to ask them to do something else is kind of illogical almost.
Right. So when we listen, Monish, to what you were saying earlier about the changes that are going on with the private sector window and building up the technical assistance capabilities, that sounds like it's getting at a lot of what the constraints have been in the past. And people have always talked about guarantees. They're not priced correctly. And as Joan's saying, they're very difficult to do. And much of what the private sector window is offering is new types of guarantees, right? So the question is really, that's great. Is it enough? Is it going to be enough? And do you also need some of the things like what Amit was referring to, and also what Joan was referring to, more interaction with other financiers across the capital spectrum, and maybe more interaction with other DFIs, so that you're just getting a much bigger scope of resources to the table.
Yeah, no, absolutely. So this is exactly the business model and culture shift that I was referring to. That's we are sort of in the midst of at IFC. And to Joan's point, yes, it is incredibly hard for an investment officer, as it is, to pull together these various aspects of a transaction in difficult markets. So what we have tried to do is by building out these programs like the private sector window and even their deployment based on certain programmatic approaches to make it as flexible or as supportive as possible for our investment officers to actually put these instruments to work. And also the capital increase that Nancy was referring to as part of the policy package commitments alongside that capital increase. We have actually indeed agreed at IFC to increase our proportion of financing to low-income countries, which are mainly IDA and fragile markets, from the current less than 20% to 40%. That's a huge shift given the challenges in those markets. So that's certainly going on, but it's not going to be easy. Second, I think it's important that references were made to the limited amounts of ODA and public and donor resources available, and that's a real challenge. So what can we do as DFIs to make sure that we make that limited public resource or donor resources, concessional resources, stretch as much as possible? And that's where I think these structuring skills that IFC and other private sector oriented DFIs have. Because if you use limited concessional finance in a manner that is, best placed to actually help make that transaction viable, so no more than that, then you're using that concessional finance as efficiently as possible, and then allocating other risks or other aspects of the transaction to where they fit best. So that structuring is absolutely important. Another way in which I think we can stretch these resources further, and we are beginning to see more and more of this happening, and this is very much part of the PSW, private sector window structure as well, is the use of what we can think of as returnable capital. So versus the more traditional donor grants approach to support concessional finance, we are now looking at structures which actually allow some reflows, with some obviously below market, below commercial returns, but some reflows back to the donors so that the money can be recycled back. And the donors can also look at it a bit differently, perhaps as part of the investment part of their balance sheet as opposed to a spending part of their fiscal part of their balance sheet, of their accounting. So there are different ways in which we are trying to make the best use of limited available resources, along with developing market conditions so that you actually do good transactions that develop these markets, that create those markets, because then you can have much more capital from regular commercial investors come in.
But I guess, right, there's always that underlying question of how ready are the markets to take the money, which is a separate issue, but it certainly has had a lot to do with the slowdown. But I'd like to just maybe come back to you a little bit later, just to get a sense of when you think about what the financial impact and how much money you might be able to mobilize by these new changes. What would that number look like? But before that, I want to go to Nancy, because there's this issue kind of right now, which we're all talking about, which is really how much can the existing DFIs really do what's needed, right? And how much might they be expected to do something that they can't completely do, right? And Nancy, you've been thinking a lot about this. Your approach has been that there were some gaps, as you mentioned before, in the in the financing and also in the institutional architecture for development finance. And so you've proposed a way to fill that gap, right? So maybe you can tell us a little bit about your stretch fund, and why you think something like that would be needed.
Yeah, thanks, Allison. And the way I think of it is that these institutions are very motivated to move into low-income countries and to do very impactful projects and to mobilize more finance, multiples of their own commitments, which is not what they do now for the most part. But they have these enormous advantages. They're in the ground in every country. They have very low cost of capital. They're extremely credible in terms of project due diligence, in terms of ESG standards. And as we've been discussing, they can engage both the public sector on the public side of their bank groups, as well as the private sector, so they can work on the environment. What they don't have is something that can help them tolerate a huge amount of additional risk. And that's really what we're talking about here, both because of its movement into low-income countries, but also because we're in an environment now with heightened risk, and it's going to last a long time. So what I'm suggesting is to add an instrument that will give them the capacity to manage more risk. So it would be an off-balance sheet vehicle that would work with multiple DFIs, that would take very subordinated positions equity positions, first loss positions, do guarantees. So its instrument mix would be very different from the senior lending dominated portfolios of the institutions. It would be very explicitly capitalized by shareholders that are content with much lower financial returns, or perhaps even just preservation of capital. It would operate in the early stage space, so it would be much more focused on innovation, and it could even combine capital from governments as well as capital from foundations and others interested, philanthropic investors and others interested in a catalytic investment where the mobilization is really multiples of the catalytic capital. So I see this proposal as not replacing the DFIs, but giving them an additional tool to move them in the direction that they want to go. And because it's catalytic capital, I don't see the additional capital that you'd have to put in the stretch fund as a huge amount of capital, because it would be the part of the capital stack that's very catalytic, and so it would be small in relation to the amount of finance that would be mobilized. You could do this with a new institution or a new entity. You could take an existing entity that has the right characteristics and build on it. I think over time, maybe the rest of these development finance institutions would evolve in that direction. But I don't think it's realistic to assume that they're going to leap into that kind of activity all at once in the short term.
Right. Okay. So I want to get Ahmed. I want to get you and Joan's comments on this. We're not going to go into all the nitty gritty, obviously, of what but just the idea of, is something like this necessary? And I guess another question, and you raised this yourself, Nancy, is, are there things existing right now that you could actually use to play this role? So Ahmed.
Well, I think just at a high level, I think taking a step back to try to stitch together some of the different comments we've heard about this, I think it's really important around, we have this massive gap in mobilization, right, and a lot of urgency with the need to mobilize a lot more money very quickly, not only just to hit the SDGs 2030 agenda, but also given what we're seeing in the world about rising inequities and the climate crisis and all the other issues that are encapsulated in the SDGs. And I think what I like about Nancy's approach in thinking about this is, we have a set of actors with this shifting landscape. And Joan talked about kind of relatively flat growth in terms of the actual foreign aid that's being delivered. We have growing private investment capital that is interested in emerging markets generally, and and a lot of it with an impact focus. But then the role of the DFIs, this question we've had about, can they go into the deeper developmental areas, or are they too beholden due to kind of their own requirements and constraints to be more commercially oriented? I think figuring out the right way to fill that gap is absolutely critical. And I think the shareholders of DFIs will best know whether or not the DFI should move into it, or whether or not they should say we need a new entity. But I do think it's essential to fill that gap. That market extension role is absolutely critical. Because without it, we'd find ourselves a few years from now having the exact same conversation, despite the immense need around the Sustainable Development Agenda to fill that critical gap.
Right. Because there's definitely a timing issue here, which we've talked about already. And then, is there a structural issue? This structural issue as well. So Joan, I know you have some thoughts on this.
I do. There have been moments where new institutions and specialized institutions have been born that have been very useful, and sometimes inside the house of an existing institution. So if we look at Development Bank of Southern Africa, which is a regional development bank, we actually gave them an early stage grant to work on an idea we didn't give them the grant. We gave GSG the grant to work with them to develop a green bank. So their proposition was they were going to leave this ring fenced, but inside their own balance sheet, and they were going to do largely renewables deals, and those would usually be underwritten by a local commercial bank that would bring them the deal, and then they would take the more difficult position in the structure. That's a setup that has mobilization built into it, has a sort of a catalytic role built into it, and it's specialized, and it's going to start, I think, creating a new line of business in the region. So that's really exciting. Another example would be the Private Infrastructure Development Group, PIDGE, which has spawned Garanto and Infraco Africa and Infraco Asia, all of which are specialized in infrastructure or specialized in guarantees to unleash local currency financing. So when you specialize in something, you tend to get really good at it. Another wonderful example was TCX, when the development banks all put their capital into a new institution that's doing exotic foreign exchange, exotic illiquid currency hedges. And it's got, a couple $1 billion worth of book, and it's viable. So I think sometimes new ideas that are housed separately and focused on are useful, but sometimes you don't actually need it to be in a new place. You just need to look at what your assets are and figure out how to use them differently. And the IFC MCPP, with the managed co-lending, with the co-lending participation platform.
Yes, syndicate, the syndication platform,
That's it. Thank you. So essentially, that was a structure where IFC created a vehicle that allowed other investors to go along for the ride as they did certain transactions that fit certain specifications. Again, it's inside IFC. It's an existing attribute that IFC was allowed to repurpose, which is their ability to put pipeline out and create an investable basket of transactions. So you don't always need a new institution. And I would say with Nancy's stretch fund, the question is, what's the problem definition? Are you trying to do early stage? Are you trying to do venture philanthropy? Are you trying to do, what is the specific thing you want this new or embedded institution to do? It has to be pretty specific for people to get good at it and feel comfortable that that's their mandate.
Right, and again, we're not going to have time to really go into it, but I think what Nancy has done, and Amit, you touched on this, is you've just raised this point that there are big gaps. We don't have a lot of time, and maybe something else is needed to help us. Maybe it's even just something that's temporary. But I think, Joan, in some ways, it also goes back to the point you had made earlier about, DFIs have to use the capital spectrum more than they are. And this would be another way, actually, of doing that. However it ends up, whatever institutional structure it would be. So we have about 7 minutes left, and I want to come back to you, Monish, and you representing IFC, but also other DFIs as well, when you hear these questions, because again, it comes down to this point of, can you change enough to do all this, right, and fast enough, or do you think that some other kind of capabilities, and it's either that some other institution needs to be put in place, or, as we're kind of alluding to and using your term, Nancy, stretch. You've got to stretch your resources by collaborating a lot more with a lot of other people on both the financing and the TA side.
No, look, given the complexity and the scale of challenge we are dealing with, it's always good to think of different ideas and what we can bring to the table. But just to building on Joan's point of how do we first stretch what we have and then see how to bring these additional ideas to complement that. So taking the example of IFC's own balance sheet, I mentioned that we are targeting now to reach a 40-60 split between low-income countries and middle-income markets, right? Just to give you an idea, currently our business in these low-income markets, based on our metric of risk-adjusted return on capital, or RAROC, we roughly are flat. So we don't lose money, we don't make money. We end up roughly flat in the business that we do in these low-income markets, whereas our corporate hurdle rate, based on our financial sustainability criteria, we try to reach a 8% return on capital overall. So where do we make that up? Obviously from the middle-income countries. So the model already, in a way, on the IFC balance sheet, if you look at it conceptually, you can think of it as a low-income IDA private sector balance sheet and then a middle income, balance sheet with an IFC. And it's this portfolio effect, combining the two, that ultimately drives our strategy. And the way we have done our calculations based on this additional capital increase and the projections we have, we think there is scope to do that successfully. Of course, the markets are never easy; it's challenging. And then the other idea here, to Nancy's point, in a way, this private sector window, which actually is outside of IFC's balance sheet, right? It sits on the IDA, the soft loan window of the World Bank. So in a way, it is a model for a type of stretch fund, which allows IFC to take risk beyond its conventional capacity. So maybe there is something to be built on that kind of template or model to extend it more broadly.
Right. But it also requires, I guess, institutions getting big pockets of money to do that with, right? I mean, you were in a very good position to get. But I think, it comes again back to this point that everybody is saying, is that we're talking about a gap that's estimated to be $2.5 trillion a year, right? So that's huge. And so it's really, whether or not all these pieces, there's lots of pieces around, and how do you get all these pieces to work in a better way? I mean, it's always been hard to get collaboration and coordination across institutions, but this really is a very different, it's a different context, and how do you get that to happen? We have just a few minutes left. Can we just maybe very quickly, less than a minute, if you just have a last comment that you would like to make? Maybe Ahmed, I'll start with you.
Sure, absolutely. Well, I think the last thing I'd leave with is just around the point around urgency. There's a lot of great ideas on the table about how to fill this gap, and we all know the need, but really the emphasis on the time. And if it is mobilizing a new institution, either embedded or independent, or if it's DFIs extending their reach down to the more catalytic and concessionary space. There's such a tremendous amount of urgency of cracking this problem, or at least making some significant headway very soon. Because as Manish said, even building something like the enabling environment, it takes time, and doing kind of harder deals or developing new business models and developing new markets is not something that's done quickly. So we have to invest now to have those markets and those models exist, years from now, and to scale by 2030.
Right. Joan, you want to go?
I so endorse what Amit said about urgency. I can't stress enough how fast this has to happen, which leads you to doing very standard transactions, or finding a pattern that works and repeating it at scale, and finding a pattern that gets institutional money into as much of this as possible, because that's the money that has the trillions attached to it. So urgency means standardization and scale for me.
Yep. Nancy?
I guess I would just say in these conversations, there's often the repeated diagnosis of the problem that the basic problem is there aren't bankable projects in low-income countries and fragile states. So I don't believe that a lot of small guarantee funds is really the solution to that problem. I think you need an entity which is able to do innovation in early stage finance, which means all of the things that Manish was describing in terms of the enabling environment, but it also needs people who know how to do early stage equity, innovative financial instruments, and put together deals. So I see what we need as an entity that is not just a passive project taker from existing DFIs, but is capable of putting together deals and bringing to bear some risk-tolerant capital in concert with DFI capital to achieve this kind of scale.
Great. Monish, last word.
Yes, thank you. And I agree with all that's been said. Clearly, this is not an easy one, and we've got to try a combination of things. At least my key takeaway or a key message here I would like to leave behind is that as much as our resource on our balance sheet will permit, at least from IFC, we are putting a substantial chunk of our annual budget and our annual financing capacity to go after exactly these problems, which is build markets, build the enabling conditions, put in the multi-year effort,
Right.
and then use some of the successful concepts of mobilization to bring capital to play into these markets alongside ours.
Right, right. Well, thank you all so much for this conversation. I mean, clearly, you know, we're obviously not going to solve this here, but I think we've got out a lot of good points, well, and showing how difficult this all is to do, but also just keep contributing to making these points about urgency and scale and keep working at it. I mean, things are moving in the right direction. There's just so much that just needs to be done. So thank you again, and we will
you.
sign off.
Thank you. Thank you, Alison.
Very much.